welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, coming to you live from Consensus by CoinDesk in Austin, Texas. Joining me for this segment, we have Dave Seimer, CEO of Wave Financial. We're going to discuss deriving yield from crypto. Dave, it's great to have you with us. Welcome to Trade Talks.
Great, thank you for having me.
And we talk about yield so much in a very low yield environment. Tell us about how you can derive yield from a crypto strategy.
Of course, yeah. I don't know if we're going to be in a low yield macro environment for long. It seems like the world is changing a little. But in the crypto sphere, tokens are a different type of financial asset, and the great thing about them is they're infinitely divisible, but they're also like natural yield instruments. It's being those huge portability and liquidity they naturally provide allow you to do a lot of interesting things with them. So, yield in crypto comes from a couple different places. Our firm, Wave Financial, this is kind of our specialization. We're kind of a yield maximization platform in crypto. And last year we generated about an 18% APY, total across all crypto assets we manage. That doesn't count the price movement of crypto. That's just the additional strategies you can put on top of these crypto assets. So on the low end, most of the coins now are staking. You get proof of stake, where you delegate your tokens to a network. Those tokens are used to secure the platform, and they pay you with basically an in-kind stock dividend. So in the very low end, that averages kind of in the across the field, maybe 5 to 10% yield. But it's relatively riskless and free. Like you don't need to send your tokens anywhere. You just kind of put a pointer towards a network. And then above that, we do a lot of strategies for our clients around just fiat cash. So there's a huge, need and kind of a lack of liquidity in the crypto sphere. So if you have just cash, if you're willing to lend your cash in like kind of an over-collateralized manner, people will pay anywhere from like 10 to 14%, per year just to borrow in this asset class. And they do it in a way where they provide over 100% collateral. This is generally through a lot of lending protocols, or also some of the centralized, we call lending desks. They look a lot like stock loan desks.
Right, that's what I was just going to ask. It sounds very similar to what you would hear.
Yeah, the centralized, meaning humans side of that, looks exactly like a stock loan desk. But just the yields are pretty incredible. And they also borrow all the other assets. Bitcoin doesn't get very high yields now. There's a lot of Bitcoin, but if you have other smaller tokens and someone wants to borrow those for like a market neutral, strategy, or short those tokens, the yields are pretty incredible.
If you needed to access the token that you have staked for someone else, can you get that back? Is there a holding time? How does this work?
Yeah, there's various models. The vast majority are no lockup. So the tokens never leave your wallet. You hold the tokens. You basically put an electronic pointer to a pool, and that pool does process transactions for the network. That's where some of the fees come from. They're also incentivized by the kind of layer one protocols themselves. So they give away free tokens. Which is great if you're a consumer. So you earn yields there, but you can always almost always yank your tokens out any second.
Right.
So you'll stop earning yield as soon as you do that.
But 18% yield is pretty substantial. You don't get that from anywhere. It just seems on the other side, it's expensive to pay 10
It is.
14%.
Well, yeah. So obviously, like Ethereum and a lot of the major chains that go there, they have an inflation model. So if you don't do those things, you're kind of punished in a sense. Meaning tokens come from somewhere, the pie doesn't get bigger because of staking.
Right.
So now again, the transaction fees are a big part of it. A lot of what the yield they're generating out to you, and again, staking's a little lower than 18. We do some exotic strategies that are more like recursive lending and nested and derivative strategies to get very high yields. But like staking yields average about 8%, so it's still really good.
Yeah.
And it's not risky, and obviously it's presumably an asset you already want. Like you wouldn't buy a token because of a high staking yield if you didn't think the token was going to go well. The price declines. Price declines can be a lot more than 8%.
Right, as we've seen this year. So speaking of that and the volatility that we've seen in the market, what are your thoughts on it going forward? Is it deterring investors, or is it just a natural part of the cycle as the asset class continues to mature?
Yeah, it's definitely a natural cycle. I've been in the space since 2010, so
you're a dinosaur.
I've had the joy of going through, I think, 70% corrections so far. We're not there yet on this one, so maybe we'll get there, unfortunately. But and obviously the whole world is risk off right now. It was, certainly with the inflation print today, it's an unusual time, and it's for anyone trying to figure out how to deploy assets, this is a tough time. Crypto right now is a ultimate risk asset. In a sense, like it's perfectly correlated with tech stocks almost. So I think in the very, very near term, that's not a great thing, because I think we're probably heading in a recession. I think the tech industry is going to be feeling the brunt of that. And what that does to crypto in a very short time horizon probably isn't good. Now, in a longer time horizon, we're very, very bullish.
Yeah, well, I guess it's anyone's guess, what it will decouple from tech stocks is really the billion-dollar question, if you will.
Yeah, and how does it decouple? Does it decouple worse
Well,
or better?
Let's hope for the hodlers out there that it goes to the better. All right, Dave, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Market Reporter at Nasdaq.